Eric Muadid, Muadid.com, for the weekend of June 13th and June 14th, 2015. Let's take a look at how Asian markets closed, and we see that pretty much had a nice gain across the board on Friday, and that makes sense based on the charts we're going to be looking at. We take a look at how the European markets just closed, and we can see pretty much a down day, about, let's call it 1% on average. So most markets did show a decline as of Friday's trade. If we take a look at how the US is trading right now, we can see with about, let's call it here, let's take a look at, with about 3.5 hours to go, US markets Dow down 147, Nasdaq down 0.54%, S&P 500 trading at 20.94. One thing we can look at here as we go to the charts is that as far as the Nasdaq is concerned, depending on how it trades, there is a possibility that the daily RSI moves below 50. If it moves below 50, then expect a bigger drop for the US markets. As of right now, we are looking at the Dow already trading below 50, hence the big down day. And also as of right now, we are looking at the S&P 500 also recording a big drop for the day, relatively speaking, not that big, but because the RSI is moving below 50. So let's go to the charts. We begin by taking a look at the Canadian market on a daily chart. And on the daily, a couple of observations. Obviously, we are looking at resistance now at the 200-day moving average, and now we are below that. So that is also beginning to point down, which is not a good sign. Also on the daily, the line we've been watching for support, this line was supposed to be support, but now we are trading below that. That could also become a problem as far as the Canadian market is concerned. It needs to be above this line, which was supposed to offer its support before it had a chance of moving higher. Now it's failing, and also given the fact that we have this movement below the 200-day moving average, there's a chance this could get worse. If we take a look at the weekly for the Canadian market, we see here the potential for crossover between the 13-week moving average crossing below the 34-week moving average. That would be bearish. We also see that the last time we had a crossover between the 13-week and the 34-week moving average was here, which was sometime middle of 2013, and the market went on a nice run. And now we are looking at the prospect and the potential for the crossover between the 13-week moving average and the 34-week moving average, which could be a problem. It doesn't necessarily have to be the death nail, but it is something to watch, because sometimes that's where you start seeing markets pull back. Also, there's obviously we've been talking about this resistance level on the weekly. As you can see, recently we also came here and had a double top resistance, hence the pullback over the last couple of months. Now, if the market is to stabilize, it needs to hold generally on this level here. Let me do that correctly so we can look at this from this line here. On the weekly, this needs to hold, because this is where we began this nice movement off the lows in summer of 2013. Market's been using this for support and bouncing higher for multiple week rally. It also used this level here for support with uniform activity, which was this re-entry back in the market. So even a pullback that brings the market somewhere here and holds is good. Otherwise, if the market cannot hold and sustain even this level on the blue line, and anything below that would also be bearish. One thing that sets the tone for a slightly bearish market here is the fact that the MACDs are pointing down, and one of the MACDs actually is below zero. So this MACD being below zero, the other MACD potentially also looking at this rate with a decline in the MACD. If it goes below zero, one can expect even lower prices. If we take a look at the Canadian market from a monthly view, and this is very important from my point of view, is because if we break this line, that's not gonna be good. So a break of this RSI lows line going back to 2009, so this line connecting all these lows, if this breaks, one can assume that this is the beginning of a major bear market. So the market needs to hold that line Otherwise, if it breaks, expect to see an accelerated move to the downside. Very critical line because it's almost about 6 years in the making, and a break of this is not gonna be good. Keep that in mind. If we take a look also on the MACDs, we see the potential for a break. If this line here connecting recent MACD lows, if that breaks, if the monthly MACD also moves below zero, one can expect some type of a major drop in the market is what I'm trying to say. Now keep in mind the last time we broke a major trend line was here in 2008. This break and also this move below zero was enough to kill the market off the 2007 highs and usher in a very steep drop in 2008. Again, we broke a major trend line in 2008 here, and it's at that break point that one needed to be very cautious, if not get out of the market or at least turn bearish. So that is what could happen if, who knows, if we find support, then the market has found some stability. But if we break this line, expect lower prices, and that could also be telling us where generally markets want to go across the board, or at least as far as the Canadian market is concerned. If we take a look at the Brazilian market by way of the EWZ, just as a quick example here, we can see we had a bearish crossover between the 13-week moving average and the 34-week moving average sometime in October of last year, November of last year, and we've had this major drop. We had a bullish crossover before that, which was during this period here, and that bullish crossover gave the market a chance to move high. So anyway, so that is what the Canadian market is potentially looking to achieve if we have that bearish crossover. Now, as far as the Brazilian market is concerned, we see that we are still trading below a declining 10-week moving average, a declining 13-week moving average, which is bearish. Also on the daily, short term, for now, we can see that we can't seem to stay above the 50-day moving average. So obviously, if the market is going to do well, if it's going to build and come off the lows, it needs to first and foremost reclaim the level above the 50-day moving average, something it hasn't been able to do so. So we have to assume that more than likely the market here remains questionable until it can move above that 50-day moving average. Let's take a look at some European markets, and we begin by taking a look at the FTSE, and we can see here that it needs to stay above the 200-day moving average, at least to hold around current levels. Otherwise, if we drop below that 200-day moving average, could usher in lower prices. We can see that now we've come off the highs, and while we were making new highs here a couple of weeks ago, we see that that happened with declining RSI strength, and since that negative divergence confirmation, we see that prices have generally crept to the downside. Now, as far as support is concerned, we can see that if we take a line connecting recent lows on the daily RSI, we see signs of strength. So connecting recent lows like that, the market did come here as we discussed last weekend and held, and there's also another line coming from the lows support line here. So this line also has been holding the market, as you can see, ever since this lows. Market's been bouncing higher, came here with uniform activity and held, which gave you those lows. It touched the line there, which gave you those lows, and now recently that held. So as long as the market is trading above those two lines, this one should continue at least trading well, and also needs to hold the 200-day moving average. Just like the Canadian market, there's this risk, and at least a scenario here, that the market could break because of this trend line. It's coming very close to that trend line support on the monthly RSI, and this goes back to 1990. So if that line breaks, you gotta be careful here, because a break of that would mean bear market behavior and lower prices. The last time we had a major break like that was here, a break of a trend line at the tail end of 2007, and we know what happened in 2008. We had this major drop, and so we have to be careful of a break in the current market right now, since it's trading very close to that line. And also prior to that, there was another break, and that break took place towards middle to the late 2000. And after the market did break this trend line here in 2000, of course, we know we went into another bear market action. So we need to be careful with the current market, because if we break this type of support, that's not gonna be good. We take a look also at the monthly, and we can see that if this doesn't hold this line of support, market could be in trouble. The last time we broke a major MACD trend line was here again late 2007, and that led to the crash of 2008. So coming back to that level could be a little bit of a trick if the market doesn't hold. Wow, lower prices are ahead. If we take a look at the German market, and this is Thursday's trading chart, this is how it closed on Thursday. We know that it had a drop on Friday because it had come here, hit that level on Friday at the close, and now down on Friday. The key is if it can hold above the line of support that we've been watching, then it's probably just not as bad as it might seem. So as long as this line is holding, which has been support going back to the entry of the lows here, this was a nice entry. RSI began movement somewhere there. This movement in the RSI on hindsight corresponds with this perfect entry, and the market has been using the same level to hold the market and keep it on a steady grind upwards. So for now, if this holds, that's okay. Otherwise, if it breaks, we have to be open to the possibility of lower prices. In my opinion, one of the things to watch for the German market is the weekly RSI, because you can see that we began this recent strong move towards late 2014. RSI broke out here. This was off the lows, and we had a nice entry. If you got this breakout on hindsight, you had a chance of having this be part of this great move. And so this line happens to be around the 50. If we draw it like that, you can see that the market has been using this level for support. As you can see, it held during this double bottom support at the 50, which was the lows here, before a nice strong spike. And so now we are coming back to test that line. As long as that line is holding, the market should be okay, even though it looks like it had a negative down week. Also, there's another line connecting the previous highs like that. And again, this line began a nice breakout. That breakout above this line of RSI resistance began this strong move. This is where it broke out, and that breakout led to a very fast-paced increase over there above 10,000. So what we are doing in essence is back testing this line. If this can hold, and also the other line can hold above the 50, then the German market should be okay. Keep in mind, if it breaks below that line, and you'll know it has broken if it is trading, if the RSI on the weekly is trading below 50, that would suggest that this has failed and probably looking to go lower. Just like the German market, and also just like the FTSE, we can see that the French CAC needs to hold this line. We discussed this last weekend, that ever since it began this entry here, or this breakout short term on the RSI on hindsight, that corresponds with these lows, and since then market's been using this level for support with uniform activity back to the line. And also this held short term for a nice multi-week move higher, and now we see that as of right now this continues to be support. As long as that's the case, the French market should also be showing that it is stabilizing, as long as the daily RSI continues to hold above this line, which is what it's doing despite Friday's drop. Let's take a look at some Asian markets. We begin by taking a look at China. China continues to be strong, even though at some point, yes, it's gonna pull back, but for now we need evidence of a pullback. And maybe somebody can say and reason that we've been making higher highs in price, and while this was taking place, we've been making lower lows on the RSI. So that could be a reason, and a legitimate reason, why the market could pull back, because you can see improving prices here on a channel while RSI showing declining resistance. Could this be setting up to go lower? we'll see. That is pretty much one of the things you want to see before a market pulls back. So that's negative divergence. Could be a little bit of a problem, a little bit of a headwind as far as China is concerned. On the weekly, man, the weekly continues to be strong. We've been talking about this since late last year. RSI has generally remained above 69.1, and as long as that's the case, you can see during this period RSI has generally stayed above 69.1, which corresponds to a fantastic move from about 2,000 to the current levels of 5,200, all in under 1 year. So this is extremely strong. As long as the weekly RSI is defending 69.1, expect more upside. Also on the monthly, we've been saying for the last couple of months that as long as the RSI is holding above 69.1 on the monthly, this is it's a scary market to try and short. So above 69.1, and as long as it's holding above 69.1, expect higher prices, just like it had this strong phase here in 2006, 2007, just before the Beijing Olympics. You can see the market took off from about 1800 all the way to 6,000. So as long as the RSI is holding above 69.1, the market should be strong. I've been saying that over the weekend, it's only until we move below 69.1 that the market can pull back like it did here. So until we see a move below 69.1, it's not the type of market that you'd want to be short. We take a look at the Hong Kong market, the Hang Seng here, and we can see that on the daily, it continues to show support just like some of the European markets based on this line. And why that line? Because this is where the market has been bouncing over the last year or so. There was support on this line which gave us these lows, and again support on this line which gave us these lows also. So as long as the market is holding there, one can expect that this is a market that should see higher prices. Why? Because it's holding on a line where it needed to hold, and by showing that evidence of support, one can see it bouncing. Also, there's a line connecting recent lows, connecting the lows very nicely here, and also recent lows, and bouncing on this line. So as long as it's above those two lines, one can expect this market, the Hong Kong market, to be okay. Take a look at the KOSPI, and you're going to see similar type analysis. It's coming back to a level where it needs to show support there, and as with the move on Friday, it shows support. As long as this is holding, one can expect that after this recent highs and a pullback, that this could be where it holds, as long as it continues holding above that line. Also, we can see the same type of analysis as far as Japan is concerned. Line connecting recent RSI lows, did find support on the daily and had a strong move on Thursday because it moved its daily RSI above 50. So that support line held, and it also coincides with the line where it has been bouncing. So this green line began this nice move and that nice move. So this nice move began a very strong move in the Japanese market. You get the right color here. We had a nice run. We've been bouncing on that green line since during these lows. We held here again during those lows around the 50-day moving average. We came here, we kissed the 50-day moving average, and now we are also showing support on that line. So again, another market showing nice support. If we take a look at, let's take a look at the Indian, and as far as the Nifty is concerned, the Nifty is showing the potential for turning bearish, and I'll show you why. Here we have potential for crossover between the 50-day and the 200-day moving average. So the 50 and the 200-day moving average could be showing a bearish crossover, which would be bearish by itself without adding other things. We can see the last time we had crossover, it was bullish 2 years ago, and you can see crossover here, the 50-day moving average moving above the 200-day moving average, which led to a nice eventual move in prices. So that's the bearish argument. Now there's a bullish argument coming off the lows here. RSI began the movement right there, and it is that movement in the RSI that launched the market to a nice multi-year rally here. So we can draw a line from here like that, and we can see that market's been using this for support here, nice lows, support here, nice lows, support here, nice lows, and on and on. So this is where the market has been seeing support short term for a slight move higher. Now we are back in this general area. If this holds, I think the market shows that it could find stability. So yes, we are seeing evidence that the market could go lower, but we also see evidence that the RSI could find support. In fact, if you take a look at a 1-year daily for the Nifty, you can see that if you take the lows line and draw a simple line like that, the market is holding RSI support. So very clearly, if this line holds, connecting recent RSI lows, if it holds, expect this market to coil and go higher. Otherwise, if that line does not hold and we break below that, one can expect lower prices. Very simple. Either we hold support on this lows line and bounce, or we break that line and go lower. On the weekly, let's take a look at the weekly RSI for the Nifty. Number one on the Nifty, a couple of observations. Again, we come back to major observation, 13-week moving average and the 34-week moving average. Here we had a bullish crossover between the 13-week moving average and the 34-week moving average that led to this major move higher. Now we are looking at the exact opposite, which is the 13-week moving average going below the 34-week moving average, suggesting that we could be looking at a market that wants to go down. So that's a problem right here, this crossover. Also, if we take a look at a multi-year weekly chart, and I've been talking about this the last couple of weeks, as far as the Nifty is concerned, on a multi-year chart, there's a problem. If you take a line connecting recent RSI lows, this line is breaking. So as long as this line is breaking on the weekly RSI, this is not a good sign of where the market wants to go. And that would be a problem. Also, we take a look at where the MACDs are trading, and as far as the Nifty is concerned, MACDs are both trading below zero, and as long as the MACDs are both below zero, one can expect this market to be in a pullback, if not in a straight out bear market phase. Let's conclude by taking a look at the one market, which the African market, which being South Africa. So we can have some representation from the continent there, and we can see that it needs to hold this RSI line here where it's been bouncing, and you can see clearly that the market's been using this for support over the last couple of years when this market has been on a very strong run. So if it can hold that line on the weekly RSI, one can expect this to bounce. So that's the good argument. Now, if we take a look at the monthly chart, there's a problem here because the monthly is showing the break, and this break in the monthly is very close to making a 3-year low right there. So if we break to 3-year lows on the monthly, expect there to be the beginning of a major bear market. Also, we can see that if we take a look at the market here on the MACDs, we can see that the MACDs, at least one of them, could very easily break the trend line to 3-year lows. So yes, the market has yet to break, but there's a threat that the South African market could break. In fact, if I take a look at the 34-month chart, so 34 months, and we can see that this is breaking down. So this is already trading at 34-month lows as opposed to 36 months. It's just a slight adjustment, and this break here could be a problem. We are also now below 69.1. Keep in mind that during this phase when the market was trading above 69.1, throughout all this phase, the market has had a major run. Now, if we continue trading below 69.1 on the monthly, that indicates the beginning of a major bear market. Also on this 34-month chart, we can see again that the MACDs could easily slip and be trading at fresh multi-year lows. So yes, the market could find stability on the weekly chart. Otherwise, if this weekly chart does not hold, so if this line does not hold on the weekly, as far as South Africa market is concerned, expect lower prices. So yes, some of the markets in Asia are showing support, but yet again we see that there's a possibility that some markets like the Canadian market and the European markets, if they break their monthly trend lines, expect lower prices. Eric Mwathe, Mwathe.com. I should have part 1 of the US market analysis sent to you sometime Saturday morning US time. Eric Mwade, enjoy the weekend. Good luck. Peace and blessings. E-A-C-S. I am out. Yeah.